One of the joys of having a job is that you earn money, what we call your gross income. All the money you earn is called your gross income. Unfortunately, the amount of money that you actually take home and are able to use is not the same as your gross income. Your take-home pay is what we call your net income. And the reason why there's a difference between what you earn and what you take home is due to something we call deductions. Amounts taken off of your gross earnings to determine your take-home pay. So what are some of those deductions? Well, employment insurance is one. Everyone who works pays into the EI plan so that if they should lose their job at some point, the government who runs the EI program can give the person a limited income for a period of time until they find another job. Another deduction from gross pay is Canada Pension Plan contributions. And again, this is a plan run by the federal government that every employee pays into a certain amount per year so that when they retire at age 60 or 65, they are given a pension, an amount of money to live on for the remaining years. Other deductions include union dues, registered retirement savings plan contributions, which are contributions to individual savings plans to supplement the amount of money one would save in the CPP. Other deductions that exist: income tax, both federal and provincial, amounts paid to the federal and provincial government for government services. Now, all of these deductions have formulas that determine the amount that the individual employee will pay. In terms of income tax is determined based on what we call taxable income. Said another way, your taxable income is the amount that is used to determine the amount of federal and provincial income tax that you will pay. A percentage of your taxable income is used to determine the amount of federal and provincial income tax payable. Again, your income tax is based on your taxable income, not your gross income. So the question is, so how is your taxable income determined? This amount being a lower amount than your gross. That's a good thing. Your taxable income is a lower amount than your gross, and therefore your amount of income tax paid is based on this lower amount. How is taxable income determined? Well, there is a formula for taxable income, and that is taking your gross income minus what we call a basic personal exemption. This is an amount of money that the government has determined will not be included in your taxable income. So it's a certain amount that's specified, minus your non-taxable deductions, which you'll notice were the ones we talked about up here: EI, CPP, RSP contributions, etc. So knowing your taxable income allows you to calculate your provincial and federal income tax, which then all of that, your income tax and other deductions, along with your non-taxable deductions, are all subtracted from your gross income to determine your net income. So let's take a look at how to calculate the net income for a person who has a gross income, total earnings, of $70,000. And the calculation for take-home pay always begins with calculating the amount of CPP and EI this person needs to pay during the course of the year. And that amount is determined by rules set by the government. Here are the CPP rules for 2017. So the amount of CPP you will pay will depend on how much you make, but only up to a certain amount. You'll notice that the maximum pensionable earnings is $55,300. In other words, the amount of CPP you will pay per year will not go up if you make that amount or more. Less an exemption of $3,500. So actually it's $51,800. So for the person in our example, their CPP is based on their gross income minus an exemption. An exemption is just an amount that is not used to determine how much you're going to pay. It's taken off of your gross. So in this case, that's $66,500. And since our person here is making more than the maximum earnings, we don't need to calculate 4.95% of that amount. We see that our maximum contribution is going to be $2,564.10. This is the amount of CPP our person will need to contribute to the Canada Pension Plan throughout the year. If this amount had been less than the $51,000, then we would have taken 4.95% of that amount to calculate the annual CPP contribution. But because this person is above the $51,800 threshold, we know that their contribution maxes out at $2,564.10 for the year. In terms of contribution to the EI program, this is based just on your gross. And again, there's rules for this over here. If you make more than this amount in gross income, which this person does, they're going to pay $836.19. So your EI contribution for this person, $836.19. Again, if they had earned less than this amount in gross, then we would have taken 1.63% of that to determine their EI contribution for the year. Next, we're going to look at how much income tax does the person pay. And remember from our earlier discussion, the amount of income tax you pay is based on your taxable income, which is determined by your gross income, $70,000 for this person, minus a basic personal exemption. All right, if we look on the right at the personal income tax rates for the year, you will notice that there's an exemption of $11,635. In other words, we will not have to pay income tax on this amount of money. So that's being subtracted from our gross, along with our non-taxable deductions, which were our CPP and our EI, which is why we calculated them early. And when we do this, we get our federal taxable income, which is $54,964.71. This is the amount of money upon which our federal income tax will be determined. Now, when it comes to how much federal income tax am I going to pay, we're going to refer to this chart again on the right. And what this table is saying is that depending on how much taxable income you have, that will determine the percentage that you pay. And you'll notice that the higher your taxable income, the higher percentage of tax you will pay. Now, important to point out that on the first $45,916, a person will pay 15% in 2017. So our federal tax, we're going to pay 15% on our first $45,916. That will come out to this amount. On our taxable income more than $45,916 up to $91,000, we're going to pay 20.5% on the remaining amount over this. So we need to take our taxable income, subtract off our $45,916 because we've already paid 15% on that. And that amount is going to give us our remaining tax, our remaining federal tax. And that's $1,854.99. So now this amount and this amount will be our total federal tax, which is $8,742.39. So we need to keep track of that amount. Now there is also provincial income tax that needs to be calculated. And similar to federal income tax, this will be based on our provincial taxable income, which is a little different usually than your federal taxable income, but it's the same formula that we used right here. So we're going to take our gross minus our exemption. In BC, we don't need to pay provincial tax on the first $10,207, which is what that means. So that comes off of our gross. and subtract our non-taxable deductions, which were our CPP and our EI once again. So let's subtract those off, and our provincial taxable income is this amount. Now, to find our amount of provincial income tax, we need to use the tables provided by the province of BC. So as you can see, on the first almost $39,000, we're going to pay 5.06%, which is 0.0506% of 38,898. And on the amount over that, anything between 38,000 and 77,000, that's where we are, we're in this category. On the remaining amount over that, we're going to pay 7.7%. So if I work these amounts out, I can find that my total provincial income tax will be the sum of these two numbers, $3,315.53. And we are keeping track of this amount. All right, we have now worked out most of our major deductions, and we're getting close to calculating our net income. What we need to do is list out our total deductions. So we had our CPP, we had our EI, and we had our federal income tax, and our provincial income tax. And we're going to assume no other deductions in this case, although there may be deductions for other things, as we talked about before, union dues, charitable contributions. Our total deductions, if we add all that up, the total amount that must be deducted from our gross income over the course of the year, $15,458.01. This is the amount of money that I won't be taking home out of the total of $70,000 gross that I earned. What I will be taking home, my net income, is my gross minus all of these deductions for a total take-home annual amount of $54,541.99. So my semi-monthly net income will be my annual net income, paid out twice a month for 12 months, so paid out 24 times a year, which comes out to $2,272.58.